Welcome to BetterBooks with Kathy Houston. In this training section, we're going to be discussing retained earnings, exactly what that is, and how that affects your financials. What is retained earnings? Retained earnings is the amount of money that has been reported on your tax return as net income for the previous year or years, minus any shareholder distributions. Thus, retained earnings is the amount of money that you've previously paid tax on. This is the amount of money you can take out as a distribution without paying additional tax. Let's take a moment and pull out your tax return for last year and let's review. The two most common small business tax returns are a Schedule C, where you're claiming your business income and expenses on your personal 1040 return, or as a 1065 or an 1120S separate return. Let's look at these more in detail on the next two slides. If your business tax return was included on your 1040 as a Schedule C, your net income number on your tax return should equal your net income number on your income statement. This amount may be slightly off due to depreciation and/or meals and entertainment adjustment. Your retained earnings number will not reflect these adjustments because they're tax adjustments, not book adjustments. If your business tax return was filed as a 1065 or an 1120S, you need to make sure that your financials tab your balance sheet on your tax return. If your balance sheet on your business tax return is not completed by your tax preparer, it could be because you're a new business or you did not supply them with your balance sheet, or worse, your balance sheet was really bad. If none of these are the case, you need to find a new tax preparer. Not filling out the balance sheet portion of a business return usually means they don't know how. When should you transition from completing your own tax return to a professional? The easiest answer is when you make enough income to pay tax. When your business generates enough income to pay tax, your business is worth a change. Again, you have to treat your business like a business. With that being said, I want you to find a great tax preparer. So you need to look for these qualities. Number one, interview them. Take your tax return and your financials with you to your first consultation. Do they see any errors? Can they offer any suggestions for tax savings? Are they familiar with the accounting software that you use? If not, is your accounting software inferior? Are they not up to date on the newest technology? Can they quote you a price based on last year's tax return? Do they do quarterly reviews in tax planning, or do they only focus on end of the year tax returns? If they don't do quarterly reviews, find someone else. Your business may not be ready yet for quarterly reviews, but a professional will monitor your business and be able to help you grow when you are ready. Once you have a large tax bill that you can't pay, it is too late. So be proactive. It's better to pay for great tax advice than to overpay in taxes. Once you've tied all of your balance sheet accounts and they are all in balance, it's time to review your income statement or your profit and loss. Print your income statement with the same ending date as your balance sheet. There's only one account on the income statement that should have a negative balance, and that's our refund account. This is an income account but reflects a negative balance for refunds and offsets current income. If you see any other negative accounts, you need to investigate to make sure that the transaction is coded correctly. The most common reason for this mistake is that maybe a deposit was miscoded as an expense or vice versa. To fix this problem, just open the transaction and change the account it is coded to. If you have already reconciled that period, it's probably a duplication that can be deleted, and you need to go back and review the bank account section. The last step in checking for errors is to review your income. Depending on how you enter your deposits or your income, there are some opportunities where some transactions could be coded to income that might not have been caught when you were going through your bank reconciliation to look for any stale or duplicated deposits. So I always tell everybody at the end to just review down through all of your income items on your profit and loss and just make sure that there's nothing unusual sitting out there, especially negative numbers. Sometimes those could be expenses. This is a very important step, but once you're satisfied with the financials and you want to close out that year, you need to lock the financials so that the numbers cannot be changed in the future. To do this, refer to your specific software for closing your books, or some software calls it set date/password. Doing this will create a pop-up, so if anyone tries to delete a transaction from a previous year or post a transaction to a previous year, it will give you a pop-up and say, hey, are you sure you want to do this? And if you want to bypass it, you have to put in the password. But most of these transactions are just mistakes anyway, so it's just one more preventative measure to ensure that your transactions are always correct. Congratulations on finishing the BetterBooks Basic Training Program. If you're continuing with the advanced training, I will see you again on the first section. If this is the end of your training, please refer back to any individual training section as needed. My hope is that you found this training valuable to your business and the future of your books. I wish you much success.